Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. You're listening to Destination Retirement. I hope everybody's having a great summer as we come about almost August already. Just can't imagine where summer has gone. Kids are already getting ready to go back to school, which is surprising, but hopefully everybody's had a great summer. So a lot to get to this week. Want to go over the market, want to go over tax strategies, want to go over the most recent note pricing, I want to go over Bison Alpha and dollar cost averaging. We just have a lot to get to. So if you are listening to us for the first time, welcome. For those of you that don't know, we're headquartered in Chicago. We are, Oak Brook, just outside of Chicago. So we're right across from the mall. So we love it when people stop in to see us, even if you don't have an appointment. We'd love to meet you. We're on the 5th floor, so right across the street from the mall. If you know where the Fidelity office is, they are on the 1st floor, and we are on the 5th floor. So just type in Fidelity Oak Brook, and you had found us. But we're in Suite 530. So the market obviously is challenging. It's always interesting when we look at kind of, we do the radio show to get out our message, obviously. And when you look at what the market is doing, generally when there's volatility in the market, a lot of people who have talked with us in the past and haven't moved forward, or those individuals who have never reached out, our phones start getting very, very active again. And we're kind of in that period right now. And our goal is to make sure that you reach out to us if you find any value in what we're doing before that happens. But I know it's human nature that if it's not broke, don't fix it. But there's a lot to get to and a lot to talk about. So we are an SEC registered investment advisory firm, manage just over $200 million. Work with 300 families in 24 states. So if you're catching this on the podcast, know that we do work with individuals. Can't say all over the country because it's only 24 states, but we do have a presence in a lot of areas. So we would love to still be able to help share with you what we're doing. I've always thought you can't be defined by the advice that you get just based on your geographical location. And that's something that, we take very, very seriously, because there is a difference between what we would consider institutional advice that, has strategies that can reduce taxes, that can deliver, some sort of cash flow in down markets, versus, going to somebody because they're right down the street, but that doesn't mean that they're a good advisor, or, hopefully everybody's a good advisor, but maybe they're not giving you the most robust risk management strategy. And candidly, that's something that we haven't had to talk about, but we're certainly going to talk a lot about that today. So 630-492-1912. 630-492-1912. If you do want to catch a live webinar on Bison 2, which is our energy strategy, and just so you know, that is here in the Midwest, an incredibly unique strategy, just simply because oil and gas investing, alongside the majors, the Exxon, Chevrons, Conocos, in the number one oil field, certainly here in the United States and the Permian Basin, is not talked about a lot. I don't think there's really any advisors that talk about that, and it is our fund, and so we do raise considerable amounts of money, and the tax benefits always attract people's interests. We always target for $80,000 per $100,000 invested as a tax benefit that can reduce active or passive income. So we're starting to see a lot of real estate investors, especially guys who were investing in syndicated, apartment communities. They're starting to look for, other answers, because that space has been very, very challenging, and it'll probably continue to be very, very challenging. So the tax benefits are significant. Now, I have to tell you that I'm not licensed to provide tax advice, so it's obviously always best practice to reach out to whoever you receive your tax advice from, and this truly is, given I don't have the license to provide tax advice for informational purposes only. K1s went out for last year. They were significantly greater than the 80% target. But again, we're not looking for one fund, two funds, three funds, four funds. Our goal is to raise, a couple $1 billion over the next 10 years, $1 billion plus. And so we want to be very, very, very realistic in our targets. And so we do have live webinars that you can watch. We try to do the webinars daily. We are also implementing on-demand webinars. So when it fits your schedule, that you can watch those. And it's a 45-minute educational video on kind of private energy and why it may or may not make sense to you. And it is kind of the Wild West out there. And so if you haven't vetted any deals in the past, certainly use us as a sounding board, as just an extension to your due diligence team, because it's important. It's important that you know what you're getting at, because unfortunately all marketing is good marketing generally, and you don't know what you don't know until it ultimately is too late. So with that being said, 630-492-1912 if you'd like to get on the list, the invite list, or have a link sent to you so where you can watch that. It's really appropriate for you. Have to be accredited, so $1 million net worth, not including your primary residence, $200,000 of single income, $400,000 of joint income, with the reasonable expectation that is going to continue, or I believe the SEC is now assumed that you're accredited if you put more than $200,000 into a fund like ours, then you meet that accreditation status. So, but again, the tax benefits are significant. The returns, it's a buy, stabilize, then sell strategy. We're equity, partners to the in the majors projects. It is relatively simplistic. It's just going to generally be new to you. So tax benefits are coming up. This fund is going to close. It's targeted to close 12/31. We'd like it to close, end of third quarter. So we have another maybe 20 million-ish to raise. And then we'd, be on to our new fund for the capital raise, where we could start to build up a cash reserve, and then really in Q1, Q2, where deals are generally there to be had, because not everybody is needing to buy at the end of the fourth quarter, have money to, do what we need to do. So if you sold a business, sold a practice, if you're a high wage earner and you're looking, for tax deferred strategies, because when you look at tax deferral and significant tax reduction in the financial planning space, I think it's the most overlooked area. So 630-492-1912. The notes, obviously, if you've listened to us in the past, we are heavy proponents of the banknote strategies. Banknotes are offered by, at least the ones that we do, the largest, most creditworthy banks that we believe in the world, the JP Morgan, Citigroups, Bank of America's, BBVA, BNP, pretty much banks that they're just, their credit worthiness is great. It's Goldman, et cetera. And in markets like now, I think people are starting to see just the value of those, especially in volatile markets. And so our current structure, as many of you know, we do index-based notes, but we've also started to incorporate individual stock-based notes. And everything that we do, we'll put the latest prospectus in the latest note offering generally. It may be, a past note, but we try to keep up with it so you can see it, so you can read the prospectus, so you can see the preliminary prospectus, and so you can see the the structure. You can see how it works. We also have a video that walks it through. Again, it's a relatively simplistic strategy, but it's new to you. So these are things that you have to, kind of just go through. And so the index notes that you've, come so familiar with us talking about, the most recent one we did was 12.5, our tier one, 12.5%. That was a Goldman Sachs note. Our tier 2, we don't have the pricing on that. We should know that here in a few. What we call our mini Mag 7, even though it's only 3 of the Mag 7s. This one actually, and we're starting to get a lot of interest in these, especially, what's going on in the market. But this one priced at 27.6%. TD Bank was the issuer of that, and it was Google, Meta, Amazon, and actually priced this week. By the time you hear this show, it'll have already priced, but with the volatility, it was really, really strong, and so it really helped out. But yeah, 27.6%. And again, let's just break down kind of the individual stock notes, because there's a lot of people in the next segment. We're going to talk about Bison Alpha. We don't talk a whole lot about that on the radio, but we're going to talk about that and why you may want to consider that and where we're positioning it. But there's a lot of individuals that either own a lot of the Mag 7 and they've become incredibly wealthy from it. I mean, we've met with people and worked with people who may have 100,000 and it's now at a few million, or a couple million and it's now at 15, 20 million. I mean, significant. And so we decided that here's a way to get some exposure to these individual stocks, even though you don't own the equities, and still get what we would consider to be a pretty decent rate of return. So it priced at 27.6 TD Bank. And so when it prices, which I believe it priced on Thursday, at the end of the close of business on Thursday, they lock in the closing price of those 3 stocks. And then every month for the first 6 months, they'll look at those 3 stocks. And if neither of those or any of those stocks are down more than 30%, then you get paid your annualized 27.6%. So what is that? 2.25% or something like that. So, I mean, it literally is that simple. For the first 6 months, that's what they're looking at. And given the volatility, it's priced very high. I think the last one we did, it was 22%. So 27.6 with 30% downside obviously could be appealing. And anytime we talk about these strategies, I don't know you, you don't know me, we don't know your situation, we don't know if it's appropriate for you. It may be too risky. It may be too conservative. I mean, this is really for educational purposes only. And so we share these strategies with you. So if you do find something appealing, then reach out. Let us learn about you. Let us learn about what you're trying to accomplish. Let us learn about your goals, your objectives, your financial plan. If you don't have a plan, if you don't have a tax plan, if you don't have a tax reduction plan, if you don't have an RMD plan on how to minimize taxes, if you're looking for somebody that you are in the Medicare stage and you have to start to go through that whole process. Now, I don't want to know anything about it, but we have partners that's all they do. They live and breathe it. And so let us help you with that. But again, 27.6%. So yeah, as long as they don't drop 30%, which they could. And if they did drop 30% from issue, so your issue date is the reference point for the life of the note. And if they did drop 30%, one of them did, then you wouldn't get your coupon for that month. And it doesn't have anything to do with future coupons. Every single month they're going to look at it independent. So we're going to talk about Bison Alpha and our hedge fund strategy, and then we'll dive a little bit more into some topics that Jamie Dimon said after the break. But 630-492-1912, 630-492-1912.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm headquartered in Oak Brook, right across from the mall. So 1415 West 22nd Street. We're on Suite 530. If you do Google Fidelity, they're in the same building. So if you want to speak with us, just come up to the 5th floor, turn left out of the elevator, any of the elevators, and we will gladly welcome you in. So 630-492-1912, 630-492-1912. So we were just, last segment we were finishing up with the most recent banknote and the Mini Mag 7. It always gets so much interest, just so much interest. And rightfully so. The last one we did, it priced at 22. This one priced at 27.6 from TD Bank, Google, Meta, Amazon. So Google, Meta, Amazon, as long as those stocks from the date of issue, which I think it priced on Thursday, it'll lock in the closing value of those stocks. So each month they're going to look at those stocks as long as the stocks are not down. And it can only be one. The one would trigger you not getting paid. So if one is down more than 30, then you miss your coupon payment for that month. But 27.6 annualized is a pretty darn healthy coupon that you can miss half the coupons and you're still getting pretty significant cash flow on those. And again, read the prospectus. These are things that we have to go over. The scenarios, we have to look at how they work, but they're hard to compete with. They're really hard to compete with. And you look at what we've done as a firm, we're probably over 40 or 50 million of new issuance this year. That's just a guess, maybe more. I'm not quite sure. Over the last, 15 to 18 months, maybe we're at 125 million-ish, maybe a little bit more. But this is something that, investors really like. And the challenge is that most advisors don't do them. And they don't do them because they're incredibly labor intensive. If you think of the amount of volume that we do, and when these notes get called, because the earliest call date is 6 months, and recently with the market being up, they've all been getting called, well, most of them have been getting called within 6 months. It is a tremendous amount of work to reprice and implement a new note. And most advisors, unfortunately, like to do what's easy. So think about if you had a 10-year wait, and think about if you went into a banknote strategy of real money and actually getting real money to your account, what that would do with that cash flow. And then using the notes as kind of a cash flow strategy as well. Challenge is it doesn't pay us, 6, 7, 8, 9, 10% commission. And that's, I think if you took away the commissions from the annuity space, I bet you, pure guess, no research to back this up in any way, just other than 30 years of experience, I bet you annuity sales would drop 50 to 75%. So we were talking about that in the first segment. Obviously, the Bison 2, which is our energy strategy, we're trying to close that out this year. Strong targeted double-digit returns while we're waiting to exit. We can certainly dive into those, those webinars we suggest because it's new to you. Watch the webinar at your convenience. It's not a pitch. It's not it's just here's the energy space. Here's what we're doing. Here are the ways that you can invest in it. Tax benefits are obviously very significant. I'm not a tax advisor. Always talk with your tax professional. So utilize anything I talk about tax-wise as for educational purposes only. We target 80,000 per 100,000. So you could do the math if you put in more than 100. That'll reduce active or passive income, but everybody's situation's different. So it's obviously something that you need to talk with your tax preparer about and with. Last year's came in significantly greater than 80, and so we were very pleased with that. But let's, market volatility. You look at Jamie Dimon. You probably have read the article, and to be candid, I just read it, so I didn't watch it or listen to it. I don't know the tone to it. Jamie is obviously one of the best bankers ever, very well known, and he is a little, I guess, based upon what I inferred from it, hesitant on the market at these valuations, at these prices. And so, we have not experienced a prolonged sideways or down market in years and years and years. And if your portfolio, if you're worried about that, now is the time to stress test it. Now is the time to get a second opinion. Now is the time to see if you have anything in your portfolio that can really, deliver some sort of a positive results, even if the markets were to go down, or a strategy that can still cash flow like the banknotes, as long as, those indexes aren't down, 30%. So 630-492-1912, 630-492-1912. But, it's a great article. If you haven't read it, you need to. Please find it. And he's one opinion, one person. He, candidly has been probably more somewhat on the negative side over the last few years. And the markets have, pretty much defied gravity, but, they won't at some point. I mean, we know that. And the typical advice from an advisor is we'll sit and wait. Well, how about a little preparation? How about a little preparation beforehand, to where if you didn't have to give up much of the upside or any of the long-term average upside of the equity markets, like, the banknotes can provide in many instances. How about just doing a little preparation to make sure the portfolio is as resilient as possible? And that is what I see more and more, is that there just is no resiliency in these individuals' portfolios. I mean, advisors are just doing 70-30, 60-40, 50-50, whatever, still using, fixed income as a means of portfolio diversification as far as bonds. I'm classifying bonds as fixed income. Not saying bonds are bad, but you can go and do a little bit of research and just look at the AGG and see what that's annualized over the last 10 years. And it's a challenge. I mean, it is a challenge. And if you're happy with that, well, then, I mean, you're not keeping up with inflation, and you're certainly not keeping up with inflation after taxes, and the cost of living could become an issue. But we could see a prolonged period of a sideways market. We could see big volatile dips in the equity markets, especially what's going on geopolitically. And you have to be prepared. And the best way to be prepared is working with an advisory team that spends more time focusing on downside strategies that can still deliver than they do the up markets. The up markets always take care of themselves. I don't think you work with an advisor because they can, deliver a 25% return when the market did 20. I mean, that's fantastic, and that's awesome outperformance. Don't get me wrong. But I would think that you would want to work with a advisory group that could still win when the markets are down. And winning can be, the definition of winning in a down market is totally different for everybody. The way that we look at winning in a down market is, the banknotes. As long as, they're not down 30%, we're still cash flowing, even in a down market. Or we have a real asset in the energy space that doesn't have a very high correlation to the equity markets and is going to cash flow independent of what is going on in the S&P 500. And so that's just two ways of defining winning. And I know I was going to talk about Bison Alpha here, this segment, but we're going to definitely talk about it in segment 3. But I'll just do a little tease. We think winning in our Bison Alpha strategy, because it's currently a very heavy tech weighted fund, in that we think these are the best companies that are going to produce the best returns over the next 3 to 5 to 7 to 10 years. The challenge is there's a lot of volatility in those names, and you can go out and buy them, and you better hope that if you put all your allocation to them, the market continues to go up and doesn't go back down, because you're not going to take advantage of the down markets. But when you buy them in a fund, like our hedge fund, as long as we still believe those names are the names to own and they're still in the portfolio and we're still raising capital, we're doing the dollar cost averaging for you. And so you really need to think about that, because tech, there is a lot of volatility. Look at what happened in 22. I think NVIDIA was down 40 or 50%. If you sold it, look at what you missed over the last handful of years. So if you haven't taken advantage of having tech exposure, because why shouldn't you? The amount of money and wealth that the tech space in general has created has been significant. I think better than any other asset class without, doing the research. But right now at these valuations, we start to see significant volatility. You see Google beat earnings, blow out earnings, but is down 3 to 6 to 7%. Well, for us in our fund, yeah, we don't like looking at it when it's down, but guess what? If we keep adding to it because we have new investors coming in, we are keep dollar cost averaging on the downside for you. So we'll talk a little bit more about that after the break. 630-492-1912, 630-492-1912. Welcome back. You're listening to Destination Retirement with Robert Kuhn, president and founder of Kuhn Capital Partners, SEC-registered investment advisory firm headquartered in Oak Brook, right across from the mall. We are in, our address is 1415 West 22nd Street, Suite 530. An easy way to do it is if you look in Google Fidelity, we're in the same building. So I think they have a couple floors on the building. We are on the 5th floor. So come on in. If you're willing to stop in, we don't need an appointment. We just might be in a meeting. We might be on a conference call, but somebody from the team will certainly get with you. So, coming up upon August, it's been a pretty good summer. We're starting to see geopolitically a lot of issues, obviously, with the war in Iran. Oil prices are continuing as I record this show today. To go up and to the right pretty significantly. That certainly is greatly affecting, in a positive way, the Bison 2 energy fund that we run. Again, significant tax benefits. We've seen a lot of, if you do any research, you can just Google kind of the real estate, the apartment syndication space. It's to say it's been challenged would be, I think, an understatement. So a lot of individuals have parked a lot of capital there and unfortunately probably are not getting the results that they envisioned. So we see a lot of individuals that are now starting to look for other alternatives because the beauty of an alternative is, I don't like the name because it seems like it's something that most people don't do. And I guess that's an accurate statement for the investors in that under $1 million dollar space of investable assets. But generally speaking, the more money you have when you get to the 5 to 10 to 50, 100, 200 million, et cetera, you have a significant portion of your portfolio outside of the stock and bond market. And I know I was talking, about the Bison Alpha, which is our hedge fund strategy, which currently, is very tech heavy. And, if you look at Microsoft, and I haven't used this statistic in some time on the radio, but if you bought Microsoft in 2000, even including, and I think I can't remember the date we used in 2000, but you can do this exercise on your own as well. But if you bought Microsoft in 2000, reinvesting the dividends as well, it took you to almost 14 years. I think it was 14 and a half years just to get back to even. So, there's a love and hate with technology, right? In technology, we love technology. We love what technology is doing to America, but, valuations still do matter. And so I think you're going to see significant swings in the tech space. And many advisors don't have an allocation to just technology, only technology. And it's, and I don't know why, but we think that if you look at the wealth that technology has created, really since, the late 90s, mid 90s, when I started in this business, I mean, it has been extraordinary, absolutely positively extraordinary. Now, the downside is there are periods of significant weakness and there are periods of significant volatility. And if you were to go and try to replicate a tech portfolio, concentrated, tech portfolio that you're going to allocate to, you're probably going to do it, be one and done. You may dollar cost average in over, a very short period of time, but you're at the mercy of where the valuations, where the market believes they should trade at that point in time. And so, tech here recently, especially the Mag 7, is just taking a beating. I mean, a beating. And we don't necessarily view that as a negative because of our funds. These companies are still, just incredibly strong on any metrics you really look at, other than kind of the volatility metrics. But the beautiful thing about Bison Alpha is that we are doing the dollar cost averaging for you. So if you come in today, and assuming these are still the same names we own 12 months from now, the same names we own 24 months from now, and we obviously continue to raise capital, because obviously you need that for new money. But you own a piece of the fund, and so the fund keeps buying these individual equities at lower prices. So if you believe at some point there's going to be a rebound, if you believe that tech is generally a leader long term and a great way to create wealth, why not look at 5%, 10%, 15%, 20% of your portfolio to some sort of a strategy like that? So we'd love to, talk to you more about that. It's something we haven't talked a lot about on the radio. You do need to be accredited, qualified. So I think your net worth needs to be 2.1 million, or you need to have $1 million with the firm to invest in that strategy. Again, not our rules, but the SEC's rules. And so so it is a higher level than just accreditation. But those are the requirements. And if you meet those requirements, let's talk about peeling off some of your money to, how that could impact, your goals and your objectives. And we can go over, the risks, the rewards, and how we perceive it to be. And we'd love to have that conversation with you. 630-492-1912. So that's Bison Alpha, 630-492-1912. Back to the notes. If Jamie Dimon is right, and if the markets are challenging, if the markets are, sideways, and there isn't, a vertical, trajectory of the markets ultimately going up, I think the banknotes are going to be such a critical component of somebody's portfolio. And when you have them and you have them issued by the Goldmans, JP Morgan, Citis, Bank of Americas, et cetera, of the world, it really is defined outcome investing at its finest, because before we even invest in the note, the parameters of exactly how you make money, how you lose money, what your cash flow is, how you don't get cash flow. And I'm just so proud to say that, we just really have, for that investor that has, a couple $100,000 to, $20 million, we've really opened up a new marketplace for those investors. Because when you do notes at scale, how we price notes, the more we commit to a bank, the better the yield is that we are going to get for our clients. And so when you do the bank notes, you have to really, if you really believe that as a strategy, and our tier ones are still the most recent was a Goldman note that priced at 12.5. Our mini Mag 7, which is 3 of the Mag 7s, Google, Amazon, and Meta, that priced at 27%. Again, as long as those indexes or those stocks are not down 30% on that monthly valuation date, you're going to get your coupon. So if we are in a period of sideways markets, if we're in a period of prolonged kind of, the markets just aren't going to go vertical, these could start to become a very core component and a necessary component for individual portfolios. And we're in that camp that, there's a good and strong likelihood that volatility is probably going to come back, and volatility is going to really start to rear its ugly head. And investors that are working with advisors that you had thought that they had the best thing since sliced bread, because the markets just did nothing. It went up, it went up, it went up. I must be working with the greatest, the best, the this, the that. Well, I think you really find out the true value of an advisory firm when the markets go down. The financial planning side of it is we'll put our financial plan up against anybody's financial plan. Unfortunately, what most people don't understand is there's really 2 or 3 main financial planning software providers out there. So everybody uses the same ones. They just slap their logo on it. And so many guys or advisors rather today are just utilizing the financial plan at a they're just scratching the surface. They're just looking at the Monte Carlo. Do I have enough money to live on based upon, future inflation, assumptions of market returns, and then the drawdown that you're ultimately going to take out. And then you're going to get a probability analysis report, 80%, 90%, whatever that number is. That, to me, you can do that on your own. Now, we do it. And that certainly is something that we incorporate in the plan, of course, but that's not the plan, in my opinion. We have to dive into the tax side of it. We have to dive into really making sure that when you start to take out RMDs, if you have a large IRA, a few $1 million, a couple million, $1 million, $3 million, $5 million, $10 million, whatever, your RMDs at 73 are going to be significant. In many instances, we've run plans where you're going to be forced to take out $500,000, whether you want to or not. And think about the tax bite that ultimately is going to create. And so we have to look at, that Roth conversion strategy. And so many people, especially the higher net worth, higher wage earners, higher net worth, they think, I can't do it. I can't do it. I can't do it. All the advisors told me I can't do it. I can't do it. I can't do it. Well, maybe they told you can't do it because they didn't have a tax strategy that could offset, like Bison 2, our energy strategy can offset that additional conversion income. And so we can really look at it where if you want to convert and then you want to make an allocation to Bison 2 and we just backdoor into some conservative tax benefits, maybe you can do it. And it may take you 5 years. Maybe it takes you 10 years to do it. But think about what you could be saving yourself. And again, taxes, I have to always preface this by saying I can't provide tax advice. So it's for informational purposes only. Do a little bit of research on, the tax benefits, in oil and gas investing. It's, very straightforward, I say straightforward. It's straightforward to me because we do it every day. Maybe it's not so straightforward to you, but always best practice is to whoever your tax provider is, whoever your trusted tax advisor is, just reach out to them. And if you want us to have a conversation with you and them, we would love to. But those are the things that we think the financial plan is where it really gets into it. Because if you look at, most people don't understand, how a Roth IRA works, especially the higher net worth, because they've been told they can't do it and it doesn't make sense. We think taxes are going up, of course. I don't know how they don't, but obviously we don't have a crystal ball. But if we can implement a 3, 5, 7, 10 year, 15 year, whatever that number is, tax strategy that you can do a Roth conversion while pairing that with the energy strategy to reduce that taxable income bite or eliminate it, depending upon, the calculations of how much you want to convert, that is something the higher net worth should absolutely be looking at. So 630-492-1912, 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm, headquartered in Oak Brook. We talked a lot about the Mini Mag 7 note, which is 3 of the 7 Mag 7s, Meta, Google, and Amazon. And that note priced at 27.2%. So that's obviously one of the higher notes that we've priced. So those are the things that we're doing. And so we created, our alpha strategy. It is a go anywhere strategy, and we can own anything. We can go long, we can go short, we can use options, et cetera. But, we believe in tech, and we believe in the what we would consider to be the best of the best tech names. Sometimes we may add, momentum, tech name in there as well. But when we're able to, or the fund is able to continuously add capital. So as long as we have new investors, okay, now if we don't have new investors, well, we don't have money to put to work. And so we're kind of in the situation that you would be in, where if you bought, Amazon at X, well, X is your starting point and ending point. So you better hope it goes up from there. But assuming we have continued capital, which we don't really believe that we wouldn't, we're able to dollar cost average on your behalf. So if if we're going to see volatility here in the near term or midterm, it may be something you want to look at as a satellite component of your portfolio. So 630-492-1912, 630-492-1912. You need to have a net worth not including your primary residence of 2.1 million, I believe. Might have gone up a couple $100,000, but 2.1 million, I think. Or have $1 million with us at the firm that we manage, and you can invest in it. So if you don't meet that $2.1 million net worth requirement. So, but it's, it's a challenge. There's a lot going on. There's so much that, when you look at kind of cash flow and you look at, family offices and you look at the higher net worth and how they, generate cash flow. We love the Bison Alpha strategy. We love the Bison Alpha strategy because of the oil and gas, strategy. Certainly oil's, doing phenomenal now at 90 plus, but you can't underwrite deals, at least we wouldn't underwrite deals of them being successful at these current prices. Generally, we're going to use the $60 to $65 range, somewhere in that area, to make sure it still makes economic sense. But our webinars are a great way for you to start to learn about the private energy space. So if you're a high wage earner, physician, doctor, it doesn't matter. Heck, there's so many ways to make money. It just blows me away how many people are, can make money. You look at, a lot of influencers online and they're making $100,000, $200,000 a month. I mean, it's crazy, which is phenomenal. But if you look at the, higher wage earners, it's what you keep, not what you make, right? So you might want to incorporate a strategy that has some tax benefits built in. If you sold a business, if you sold a property, if you had a liquidity event in some form or fashion, if you've have concentrated stock positions and you want to start to slowly dollar cost average out, but you don't want to get hit by the taxes all at once. Well, here's a strategy that you can look at. And one of the best ways to really see and learn about that is the webinars, whether they're on demand, whether they're live. We are really taking the education component to a new level. And so the webinar that you're going to look at today, I mean, just over the weekend, I thought about 3 new slides that need to go in there because it is all about education, especially in a private investment. And when you look at a private investment, we built this strategy for, multiple billions and multiple funds. And so that's why Bison 2 is on the custodial platform at Charles Schwab. Now, Charles Schwab doesn't say it's good or bad, but we went through the due diligence to get on the custodial platform. We have third-party accounting. We have third-party fund administration, third-party audit. Every one of our funds are audited. And you look at, now the challenge in oil and gas, when you look at auditing, it's a challenge because it takes time. And it's a lot. It's a lot for us, but it's great for you because to me, that's the most important thing, that you have checks and balances, that you have third-party unbiased companies that are making sure what you think is happening is happening. And so that's why we've built this, because oil and gas investing, people think, when they think of oil and gas investing, they think of, well, is it a dry hole? Well, they don't strike oil. I mean, that's called like massive speculation or wildcatting, okay? And the risk returns for those, those types of strategies, is pretty significant, but that's not us. And I would think if somebody's coming to you with that type of an idea, why do they need other people's money? Why not just go and, if you have any resources, you probably get a group of friends or a bank to give you the money and take advantage of it all on your own. What we're doing is is creating funds that are significantly diversified. So we are a capital partner to the majors in their projects. And so you may ask, well, why does ConocoPhillips need our $3 million? Well, they don't. they couldn't care less about us. They don't. But in oil and gas, if you own a piece of that deal, a piece of that net mineral acres, you have the right to participate in their drilling program. You can. If you own 3%, you pay for 3% of the drilling, you capture 3% of the revenue. I mean, if we take it to the bare bones, I mean, that's exactly what it is. And when you have a fund like ours that has significant diversification of operators, I think we have 15 properties currently. I think we have, I don't know how many, we're closing on another asset, I think, over the next week, which will dramatically increase these numbers. But I think we have 51 producing wells. We have 550 net mineral acres. We have a couple hundred future upside wells. We have a bunch of permits and stuff. So the point being, it's a very diversified fund. So it's not a one and done. It's not like most of what, if you don't want to put, the non-operated working space is really truly owned by private equity. And to get access to that space, it's generally impossible. Now, there's funds that it will make you think that it's private equity-esque, great risk management, significant diversification, et cetera, et cetera, et cetera. But you just do a little bit of research, or you have us do a little bit of research, you'll see really quickly that it's probably not. So we've really tried to structure this for what we would consider the average investor. Now, you do need to be accredited, $1 million net worth, not including your primary residence, or the income accreditation, or $200,000 in the fund. It should never make up an over allocation of the portfolio. I mean, and that's the beauty of, we're an RIA as well. And so we are held to, different standards than if we just had an oil and gas fund. They would want you to put your last penny in it because they want as much as they can get in it. That probably wouldn't make a whole lot of sense either. So generally 5, 10, 15% allocation to something like this is generally where we're comfortable with. Certainly could be more in certain circumstances. But when you work with an advisory group that can bring you and have these conversations of these different strategies that are going to be new to you, that I think really is a good indicator of you working with, what we would call a cutting edge, risk management firm that is bringing these family office, in many instances, family office style or strategies. And a family office is, just a family. So it's a very wealthy family, 50, 100, 300, 3 billion, 5 billion, 10 billion, what have you. And they're generally going to have exposures, to these types of strategies. And we've, with a lot of what's been going on in real estate right now, the risk reward, in our opinion, it just isn't there. And so if you have been a traditional real estate investor, we really encourage you now to start to look at this side of it and start to look at the energy side of it and start to really get an understanding of, what it is and what it's not, because it's probably more important of what it's not than what it is. But tax benefits are strong. We target $80,000 per $100,000, can reduce active or passive income, but again, can't provide tax advice. So you have to reach out to your tax professional. Last year's K1s just went out last week or so, and they were significantly greater than that. But maybe next year they won't be. So that's why we always say to make a decision on, what we feel confident that we can target and achieve, because you don't want to buy something just for the taxes. But tax benefits always get the interest. But heck, we want to make money, right? Total return. And so oil and gas currently is look at the price of oil, right? It's something that you may want to look at. So 630-492-1912, 630-492-1912. So banknotes are still pricing really high. Tier 1, 12.5. Our Mini Mag 7 priced at 27.2 this week. So that was really good. And if you have any interest in these, you have to get in before they price. You have to talk with us. You have to fund the account. We have to go over the prospectus before you want to do it. By the time we price something, it's generally too late because it needs to be funded almost immediately. So if we can help you out in any way, if you want to have any questions, or if you have any questions, or you like anything that we talk about on the radio, you know how to get a hold of us, but I'll give it to you again, 630-492-1912. We look forward to talking with you more next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.